So I want to dig into everything that you're going to need to know about SBA loans and how the collateral piece works. So first off, if you are taking less than $350,000, typically you don't need collateral. All right, you don't need to put up any type of collateral to have the loan funded. When collateral comes into play is typically when it's over $350,000. And this is really important to understand what types of collateral they might ask for. And typically when you apply for an SBA loan, you're going to fill out a personal financial statement. In that financial statement, you're going to list all your assets and all your liabilities. So basically what they're going to do from that point is they're going to value any of your assets at 80%. All right, so let's say you have your personal home, a couple of vehicles and equipment, and then you have, maybe 2 investment properties. Everything adds up to $2 million. Well, they're going to value that at 80%, so they're going to take that and they're going to mark it down to $1.6 million. And then they're going to subtract what you owe on that. So let's say on all of those items you owe about $1 million. Okay, so you take the 1.6, subtract the million, and then you're left with $600,000 in pledgeable assets. And then from there, they're going to try to cover it one for one. So if it's, let's say, a $500,000 loan, they're going to try to get or collateralize at least $500,000 worth of those pledgeable assets. That's how the SBA works. Now, if there's multiple partners, they're going to do the same thing. So typically with an SBA loan, anybody that owns 20% or more has to be listed, and they have to have an application, and they need a personal financial statement. So they'll go through that exact process for each owner. And now the other question I get is if you are acquiring a business using an SBA loan, all right, they're going to also list the assets that are being acquired in that business. So let's say you're buying a business that has a building as part of it, all right, and that building is worth $2 million. They're going to utilize that. And the equipment, they're going to put that in there. So that will actually help you meet some of those collateral requirements, right? If you're buying a business, and this is important to know, if you're buying a business that doesn't have a lot of assets, that means you're going to have more assets to make up for that. All right, we see that a lot. If it's let's just say a service-based business that doesn't have a lot of assets, or the assets are older or not really that valuable, right? This matters when you're looking to get approved. So if everything is in line and you're looking for $500,000, you just want to make sure that there's going to be $500,000 in pledgeable assets, and then the bank, when it gets time, they're going to pick, hey, we're going to collateralize X, Y, and Z. All right, and as long as you have the assets there, shouldn't be an issue. That's the best way to map out and plan out anytime you're going to get an SBA loan over $350,000, what type of collateral do you need? All right, they try to avoid tying up your personal property if they have to, and that's the only way to get it done. That's the only way to get it done. But if your business has assets, or if the other business that you are acquiring has assets, they could do it that way. Hope this helps. Please subscribe, and I'll see you on the next video.